In this video, I'll be discussing some of the more technical aspects of the chapter, and I certainly encourage you to review the rest of any PowerPoints and also to read the chapter. But I wanted to go through some of these aspects of accounting where we're actually going to be discussing these accounting principles as they relate not only to individuals but to small businesses, non-C corporations. Another reason I wanted to go through some of these topics and principles with you this week is that while the assignment is not overly rigorous in terms of applying some of the concepts in the chapter, some of what I'll be discussing today does relate directly to your assignment. So from my point of view, and historically with students, the more difficult elements of this chapter were the principles and less the assignment. So I want to talk a little bit about, for example, for non-corporate taxpayers, when we talk about net capital transactions, the tax treatment depends upon the holding period. And so for non-corporate taxpayers, for short-term assets held less than 12 months, they're taxed at the ordinary income tax rates. But for long-term assets, we are taxed at a preferential tax rates. And we have several, the more common that you may be already familiar with are the 0, 15, and 20%. Again, corporations don't get the benefit of these corporate capital gains rates, these non-corporate, capital gain rates, as well as these are the same as the dividend rates for non-corporate entities. So for individuals, we enjoy the reduced, in most cases, reduced tax rate afforded to us as it applies to dividends and capital gains, which is the subject of this chapter. Also, though, we can add to that 25%. This rate applies to unrecaptured 1250, which relates to real property gains, and is related to the gain from disposition of 1231 assets, which are business assets. And we'll explore these concepts much more fully shortly. The 28% rate applies to the tax on the sale of collectibles. And as I mentioned, the 0, 15, and 20, the more rates we're more familiar with, relate directly to the sale of long-term capital gain property that is not used in a corporation. So the small business stock provision is a special exclusion available to non-corporate taxpayers. And so any amount not excluded from income is taxed at the maximum rate of 28%. So this applies only to the small business stock. The exclusion of 100% for qualified small business stock after September 27th, 2010, which is quite a change. The percentage of 50 to 75% if the qualified small business stock was acquired earlier. So if you're assisting a tax client or working with your employer, for example, you really need to know when the small business stock was acquired because that will help you to determine what tax rates to apply, because they've changed, as you can see, they've changed over time. And that's why the authors mention them, is because we need to know when those assets were acquired to know how to handle these small business stock transactions. So that's the 28% rate then as it applies. What are these types of collectibles? Well, works of art, anything unusual in terms of, rather, shouldn't say unusual, I would say unique. Often they're hard to replace. They're original, and so these are what we might consider collectible. Sometimes it's kind of a gray area, what is collectible and therefore subject to the 28% alternative tax rate. Also, we can also appeal to the IRS if we have a question about whether or not an item that we've sold qualifies for the 28% alternative tax rate. We can get a determination letter, for example, from the IRS and request a written response regarding this issue. So these tax rates are the tax rates that again apply to dividends as well. And so in the context of capital gains rates, these rates only apply to long-term capital gains. So short-term capital gains are treated as ordinary income if it's a small business, And if it's not a small business, it's taxed at the regular or marginal tax rate. We don't get the special capital gains tax rate. However, for individuals, the benefit of this net capital loss, as it applies to individuals and non-corporate entities, is limited to $3,000. So on the gain side, where we can be taxed generally at 0, 15, or 20%, depends upon our marginal tax rate. On the loss side, we, unlike corporate entities, get to deduct $3,000 per year from other income, including earned income, which is a nice benefit. If we have, for example, $6,000 of net capital losses during the year, then the remainder can carry over indefinitely. So again, some of the differences that I've already discussed between corporate capital treatment. Net capital losses only offset capital gains, so you cannot take a capital loss deduction. It can only offset capital gains. And there is no $3,000 deduction for corporate entities. Also, they're limited into carrying forward and back. Now, it is true that we cannot carry back capital losses as individuals and small businesses, only carry them forward. Corporations, they do get to carry back 3 years, but they can only carry forward 5, and if they haven't used up their capital losses to offset capital gains, then they lose those capital losses. So they do expire over time. So 1231 assets, a big part of this chapter. These are business assets used in businesses, and generally they're used to produce income, and they've been held for more than 1 year. So these assets then get special, we'll talk about this, special tax treatment, and it includes things like timber, coal, iron, livestock, and crops, and then certain purchased intangibles, not developed in-house, but purchased intangibles may get this preferential 1231 treatment. Some of the things it does not include: inventions, patents, most intangibles are not included. Receivables, notes receivables arising in the ordinary course of business can be considered a 1231 asset. Inventory, certainly not a 1231 asset. So if we do sell inventory at a loss, it doesn't get the preferential 1231 tax treatment. So transactions involving the 1231 assets, net 1231 loss is an ordinary loss, which is a benefit, right? We want to be able to take our marginal tax rate multiplied by the loss, and that would be the dollar value benefit of that loss. And then, as I said earlier, the 1231 on the gain side, just like with individuals that are not small businesses, we get those special preferential tax rates, 0, 15, and 20%. Again, corporate businesses don't get this. There are some special rules that apply to certain 1231 assets. One relates to casualty gains and losses from these business assets that are held for more than 1 year, and long-term non-personal capital use assets. And so we have to generally net these gains and losses together. So 1231 casualty gains and non-personal use capital asset casualty gains are treated as ordinary, which again means we've lost some of the benefit, 0, 15, and 20% capital gains rate benefits. But these items are handled separately. 1231 casualty losses are deductible for AGI, so they will help in determining our adjusted gross income, which is a great benefit. As indeed most business losses, whether 1231 or ordinary, are deductions for AGI on Schedule C. Now, non-personal use capital asset casualty losses are deductible from AGI, so that's, for example, on Schedule A, subject to a 2% of AGI limitation. Now, please be aware that many of the 2% of miscellaneous itemized deductions have been suspended until 2025. If we have a net gain, here's where we get that beneficial tax rate treatment for these long-term business assets. which again is a great break for small businesses and individuals as well. I would mention that personal losses for non-business losses, generally we don't get to take advantage of those losses. So for example, if I have a personal use car and I sell it at a loss, generally I don't get any loss deduction because it's a personal use asset. If that truck or car were a business use asset and I sold it at a loss, yes, then up to $3,000 a year would be deductible as at my ordinary marginal tax rate. As I said before, these losses that arise in the personal use assets are not deductible, but personal use property is considered a capital asset. So let's take that car example again. If I sell my car, personal use, and I make money on it, then I have to report that gain as a capital gain. But I don't get to take the capital loss if it's a personal use asset. And so, as I said, and this relates to one of your questions in the assignment this week, and that is that you will net together all of the casualty losses and gains based on whether they're 1231 or if they're ordinary gains and losses. And just to kind of refresh our memories, that deductions for AGI are more beneficial to us because they help determine AGI, which later is used to determine the extent to which we can take advantage of deductions and credits. So here's an example where we have a look-back provision. So the taxpayer had net business, long-term business, gains and losses, or Section 1231. So in 2016, a $4,000 loss, 17, $10,000 loss, 2018, a $16,000 gain. So the taxpayer's net 1231 gain of $16,000 will be treated as $14,000 ordinary income and $2,000 long-term capital gain. And why is that? Because the IRS and Congress are not going to give us a double tax benefit of being able to take these losses in 2016 and 2017 at our marginal tax rates, which is a benefit to us, and then turn around, and then when we attempt to recapture, I shouldn't say recapture, but when we turn around and attempt to take advantage of these offsets from previous years, those offsets are going to be treated as ordinary income again, because we already had the benefit of the ordinary income deduction, that is to say the ordinary loss deduction. Therefore, in this case, when we have income recognized as an offset to 2018 gains, that $14,000 is going to be treated as ordinary income. And then the additional $2,016 minus the $14,000, that would qualify for the long-term capital gain treatment using the preferential tax rates of 0, 15, and 20%. But again, because we had that advantage of deducting the losses of 16 and 17 at our marginal tax rates, then when we do look back and we try to offset these previous losses against a 2018 gain, then $14,000 of that $16,000 gain will be taxed at our marginal tax rates. This is a little hard to see, but it is in the text. This relates to, kind of enlarge that a little bit. This is a nice depiction of the relationship between these 1231 assets. And so we're going to be talking about 1245 assets and 1250 assets. But this is a nice kind of a flow chart that we can kind of use to determine how items are going to be taxed and whether or not we have to treat them separately. So in step one, we have 1231 asset and long-term non-personal use capital asset and casualty gains minus the 1231 asset and long-term non-personal use capital asset losses. So the first step is we net those together, right? Business use and non-personal use capital asset gains against our losses. If it's a net gain, we go to the left and we add the net gain to our 1231 gains. Now, if it's a loss, we go to the right and the gains are ordinary income. And the 1231 asset losses are deductible for AGI as any business loss would be, as we said earlier. And then any other losses that don't qualify would be deductible from AGI. And then just following the flow chart down here, I talked about the look-back provision earlier. where we have a gain offset and a look back, those losses are ordinary, and I just went through that earlier. Any remaining gain is long-term capital gain. So that exactly explains what we did here, where we looked back and took 14,000 of previous ordinary losses, and they're now going to be treated as ordinary gains. The additional 2,000 will be treated as a long-term capital gain. And that's what we see here in this flow chart on the very bottom, which is step 3A. So following these flow charts is a good way, especially now step 3 would not be necessary if we didn't have a look back opportunity. We'd stop at step 2 and just take 1231 business gains minus 1231 business losses and stop there. And we did have a net gain, which would be taxable at the favorable tax rates. But if we're taking advantage of a look back provision where we had previous losses we want to use to offset current gains, then, as I said, to the extent we took a deduction for ordinary losses earlier, that now is ordinary income. So assets are sometimes subject to recapture, and what recapture means is that if I sell an asset and I've been depreciating, and I've been taking advantage, for example, of accelerated depreciation, and I've been taking these deductions against ordinary income, then if I sell these assets later at a gain, then part of that gain may be recaptured. That is to say, part of that gain may be taxed at my ordinary marginal tax rates and not the preferential capital gains rates. No recapture occurs in loss situations, right? Because there's, we can't recapture losses and then apply the preferential 1231 rates as we talked about a few minutes ago. So what recapture essentially means then is it means that you are taxing at least part of a gain at the ordinary tax rate. That's the recapture part, as opposed to the preferential long-term 1231 or capital gains rates of 0, 15, and 20%. And just to go back and highlight this provision a little bit, how much then of a gain would be subject to recapture? Well, the gains that is subject to recapture is limited to either the lesser of the amount of depreciation previously taken on that asset that was sold or the gain itself. So you'll take the lesser of those two. I'll just say that again then. The lesser of the previous depreciation taken on the asset sold or the gain on the sale of that asset. The lesser of those two would be subject to depreciation, so that part of the gain would be taxed at the ordinary tax rates. So 1231 then is kind of bifurcated between two code provisions. 1245, Section 1245 relates to personal use assets, and Section 1250 relates to real property gains and losses. Again, both used for business purposes. So in the next video, we'll be picking up here and discussing the rest of these concepts, especially as they relate to capital gains and losses in Chapter 14.